Discover how UK bank reporting obligations operate in 2026 and why understanding financial disclosure rules can help you remain tax compliant.
Imagine waking up one day to find the government has simply bypassed the courts and taken money straight out of your private bank account. Sounds a bit extreme, right? Well, in the UK, it's quickly becoming a reality. Hello, and welcome to this explainer from Pro Tax Accountant. We're a UK accounting firm dedicated to helping businesses like yours navigate these increasingly complex tax rules. Today, we're diving into a topic that we get asked about constantly: hidden bank reporting obligations, understanding your 2026 financial privacy and disclosure rules in the UK. We see so many hardworking entrepreneurs who just assume their personal accounts are entirely private. But as you'll see today, that's a really dangerous assumption to make right now.
To really grasp why this matters right this second, let's talk about a staggering figure: £4.6 billion. That is the extra tax revenue that HMRC's Connect AI system managed to haul in during the 2024 to 2025 tax year alone. And the craziest part? This wasn't done through your traditional knock-on-the-door audits. No, this was achieved simply by the AI cross-referencing over 55 billion items of your personal and financial data. We're talking everything from your bank accounts to property portals, crypto exchanges, and yes, even social media platforms. That's a massive 35% jump over historical averages, which just goes to show that automated data-driven tax enforcement isn't some future threat. It is highly effective, it's relentless, and it's already here.
So, we've structured today's explainer around 5 key areas to get you fully prepped. We'll quickly cover 1. The current rules and stats, 2. Who exactly this affects, 3. The required compliance steps you need to take, 4. Mistakes you absolutely must avoid, and 5. A quick summary and your next steps.
Right, let's jump straight into Section 1, Current Rules and Stats.
Under the old system, the authorities basically had to rely on manual checks, paper records, tip-offs, and quite frankly, just trusting the taxpayers were being honest. It was really enforcement by random sampling, so a lot of discrepancies just slipped through the net. But those days are gone. We're now living in an era of continuous 24/7 monitoring. HMRC's Connect AI is actively scanning bank accounts, property records, and DVLA data in real time. On top of that, the new Pay for Act is giving the Department for Work and Pensions completely unprecedented access. Plus, digital platforms are now automatically sending your sales data straight to the government. You don't even have to lift a finger. They already have the data across dozens of databases that used to be totally separate.
So, why is the government suddenly deploying these extreme measures? Well, it all comes down to the UK's massive tax gap, which is currently sitting at an estimated £46.8 billion. The tax gap is essentially the difference between the tax that's legally owed and what the government actually manages to collect. And unfortunately, small businesses are viewed as a really significant contributor to that shortfall, accounting for about £13.4 billion of it. The psychology here is pretty straightforward. Rather than making politically unpopular moves like raising headline tax rates on everyone, the government is just using big data to squeeze those missing billions out of the existing system.
A huge cornerstone of this new surveillance landscape is the PFAR Act, the Public Authorities Fraud, Error, and Recovery Act of 2025. This law was literally designed to claw back £14.6 billion, and it does this by granting the DWP sweeping powers to issue what they call eligibility verification notices straight to your bank. That means they can demand to see your account balances, your transaction history, and even check if you've been using your cards abroad. And incredibly, it allows them to seize funds to recover debts directly from your accounts without ever needing to get a court order. It's a massive, massive shift in UK financial privacy norms, and every single taxpayer needs to be aware of it.
In fact, did you know that if you refuse to engage with the DWP over a benefit debt, they can actually just extract the cash directly from your bank? And it actually gets even more severe than that. If someone persistently evades repaying a debt of over £1,000, the DWP can legally ask a court to temporarily ban them from driving. That level of punitive action being directly tied to your financial data is something we simply haven't seen deployed on this scale before.
Moving on to Section 2. Who exactly does this affect?
The short, and maybe slightly scary answer is almost everyone. Whether you're an SME or a sole trader having your expenses tracked, a freelancer casually trading goods on Vinted, renting out a spare room on Airbnb, or a company director with complex offshore affairs, you are on their radar. Take a consultant running limited company expenses through a personal account, for instance. A few years ago, they might have flown under the radar for years. Today, the Connect AI builds a totally holistic profile of your financial lifestyle to see if it matches up with your declared income. Any discrepancies are flagged to human caseworkers instantly. And for our crypto investors listening, please pay very close attention to this. 2026 marks the official arrival of CARF, the Crypto Asset Reporting Framework. This means crypto exchanges, wallet providers, and brokers are now legally mandated to automatically collect and hand over your transaction histories, your account balances, and your personal details straight to the taxman. So the days of crypto just existing in this regulatory blind spot where you could kind of choose whether or not to declare those gains, those days are completely over.
Here's a professional tip from us at ProTax Accountant. Please, do not assume your side hustle is invisible. Under the new digital platform reporting rules, platforms like eBay, Vinted, Airbnb, and Etsy are already feeding your sales data straight into HMRC's Connect system. If your side income goes over the £1,000 trading allowance, you absolutely must declare it on your self-assessment return. If you don't, HMRC literally already has the data from the platform to prove you omitted it, which turns a simple, honest oversight into a penalty-carrying offense.
Furthermore, it's really important to understand that HMRC isn't just acting alone in a silo anymore. Institutions like the newly empowered Public Sector Fraud Authority and the DWP are working completely in tandem. New data access laws allow for vast information sharing between these government bodies and private financial institutions. They're sharing your economic data with each other like never before to build this unified, inescapable profile of your financial life. Bottom line, if you declare one thing to HMRC and something totally different to the DWP, those systems are now talking to each other.
Okay, let's look at Section 3, Required Compliance Steps. What can you actually do about this?
Well, as you can see, 2026 is totally packed with critical activation dates. In January 2026, CARF data collection for crypto officially begins. By June, the DWP issues their final warning letters for welfare debtors. And by October 2026, those DWP direct bank deductions are being actively enforced. The window to get your financial house in order is rapidly closing, if it isn't already shut. You really can't afford to delay reconciling your historical accounts any longer.
To stay compliant and protect yourself, you basically need to follow 3 distinct steps. Step 1. Declare every single income stream, no matter how small you think it is. HMRC's Connect system sees it anyway, and declaring it keeps you out of their high-risk band. Step 2. Perfectly reconcile your self-assessment with your actual bank data before you file. Your UK banks have already told HMRC exactly what interest they paid you, so your return has to match it down to the literal penny. And Step 3. Consult a qualified accountant to have an expert review your figures before you hit submit.
At the end of the day, meticulous record-keeping is absolutely your best defense against these algorithms. You have to ensure that your financial footprint, meaning every invoice, every single crypto trade, every offshore asset, matches the exact data your bank and digital platforms are already reporting to the government. We tell our clients all the time, a well-documented spreadsheet is the ultimate shield against an automated tax audit. Good records prove you intended to comply, which drastically lowers your risk of penalties.
Let's move on to Section 4, Mistakes you must avoid.
You have to consider the immense pressure being put on the banks themselves right now. The new penalty regimes for financial institutions are absolutely brutal. If a bank or a crypto exchange fails to submit a report, they're looking at fines of up to £5,000, plus $600 for every single day they're late. If they submit inaccurate reports, that's $300 per account holder. This means your bank is going to report your data accurately and rigorously because they aren't going to risk those heavy fines for themselves. Don't expect your financial institution to turn a blind eye or cover for any discrepancies. They are going to protect themselves first.
Did you know that HMRC Connect actually assigns you a risk score based on dynamic sector averages? For example, say you're a sole trader plumber and you claim 80% of your turnover as expenses. But the Connect AI knows the sector average for plumbers is only 35%. The system is going to automatically flag your return for a human investigation. Unusually high expense claims compared to your peers are an immediate guaranteed trigger. You aren't just being judged on your own numbers anymore. You're being judged against the statistical behavior of your entire industry. Simply putting your head in the sand is quite literally the worst mistake you can make right now. Unforced errors, things like late filings, constantly submitting amended returns, or just ignoring DWP warning letters will artificially raise your risk score. These actions signal to the algorithm that your affairs are disorganized or worse, intentionally opaque. Doing this pretty much guarantees that enforcement action, whether it's an HMRC audit, an information notice, or a DWP direct bank deduction, is going to be taken against your accounts.
Finally, let's wrap things up with Section 5, Summary and Next Steps.
To quickly summarize, the era of financial privacy by obscurity is officially over in the UK. The visibility gap is completely closed. Between the Connect AI cross-referencing 55 billion records, CARF regulations illuminating the entire crypto market, digital platforms reporting your side hustle sales, and the PFER Act allowing the state to access and deduct from your accounts without a court order, your financial data is fully 100% visible.
Which leaves us with one highly provocative question that you really need to ask yourself today. Considering the sheer mountain of data the government now holds on you, are you absolutely certain that your 2026 financial records and tax affairs can survive an automated algorithmic audit?
Before we finish up, please just remember that this explainer is strictly for informational purposes. It does not constitute formal tax, legal, or financial advice. Every individual and business situation is totally unique, so please make sure to seek professional guidance for your own specific circumstances.
The good news is you really don't have to face this daunting new regulatory landscape all by yourself. Contact our expert team at Pro Tax Accountant today. You can give us a call on 07985 689 912, drop us an email at info@protaxaccountant.co.uk, or visit our website at www.protaxaccountant.co.uk. We'd love to help you assess your tax exposure and make absolutely sure you're fully compliant. And finally, if you found this explainer helpful, please do subscribe to the PTA YouTube channel for more essential business and tax guidance. Thanks so much for joining us, and we look forward to helping you secure your financial future.